key catalyst for investors. This week, of course, earnings season. It's going to kick into high gear as we're getting results from a broad range of sectors, from financials to technology to healthcare. Our next guest says this earnings season is all about the company's reporting outlook. Joining us now, we've got Hani, who is the multi-asset portfolio manager over at PineBridge Investments. Great to have you here with us. First and foremost, as you think about this earnings season and how we're going to be kicking things into high gear, what could be perhaps the common denominator that really sets the tone for the tenor that we hear from companies over the course of this earnings season?
Yes, good morning. Good to be here. I'd say that this earnings season is fairly benign in terms of what we expect for the current quarter's earnings. It's all about how that outlook sounds from management commentary, particularly given that we're now into an easing cycle. So we've been watching out for commentary around what they expect to be doing in terms of CapEx, investment activity as interest rates come down. And at the same time, also getting a sense of the health of the consumer. You know, there had been some softness in consumer data, but with the revisions we've had, the consumer looks a lot less stretched. We'll be listening to management to hear if they see similar trends.
And Hani, what are your expectations, the models that you're running for this earnings season? Do you think it's going to live up to those expectations that we're seeing played out in terms of consensus?
Yeah, as I said, I think the bar is fairly low for this particular earnings season. Consensus has actually brought down those earnings expectations quite a bit. And so it's a little less daunting for current quarter. But I think the market's going to be much more focused on seeing where we go from here. The economy has been slowing, so earnings growth this quarter is going to be fairly modest, something in the range of 4% growth. But we sense that we're maybe getting close to an inflection point where growth can actually improve late into next year.
It's really interesting, Hani, especially you think about what you're mentioning here, fairly modest growth, low bar to top, CapEx. This is not as sexy as us talking about artificial intelligence and every company feeling like they could latch on to what is the zeitgeist for earnings and for executives to talk about. And so with that in mind, where do you think that companies are going to be investing a lot of those dollars, where that capital expenditure and the scrutiny from investors should be placed?
Yeah, it's a good point. That theme is not going away. There is an AI arms race underway. We think that continues. It's difficult to see, a rapid acceleration of the pace of that investment from current levels, but we think that these big players are not going to shy away from continuing to spend on that front. The more interesting area of investment activity, though, is what's happening elsewhere. In the lead up to this US election, we're hearing very loud and clear from our network of analysts that a lot of companies have been holding back. Understandable, given that we don't even know what the rules of the game are going to be, both in terms of policy, from tariffs to immigration to other things, but also in terms of the Fed. We were waiting for a long time for the Fed to get started on cutting rates. We think that as these events go behind us, into the end of the year, that now gives companies much more confidence and clarity to proceed with their investment activity. And that's pretty broad. It's not just in AI. And so we can find interesting opportunities away from that space in terms of investment activity.
So, Hani, then how does that feed into where you're finding opportunity? And I come to that debate that we've had with so many strategists on our air over the last several weeks of the growth trade versus the value trade and what makes the most sense in the market today. Where do you stand on that?
Sure. So look, we would still have a core allocation to those growth stocks where earnings are going to be delivered with high confidence. But, there's room for this rally to broaden out to some extent. I think you have to be very careful with this. We are not in a position in the cycle where, we've had a recession, we've had an economic reset, and we've rewound the market clock right to early cycle where you should be playing things like small caps and high beta stocks. We're not in that environment. We've had a slowdown, a kind of a soft landing is our base case. So that doesn't really set up for those type of sectors. Where we're doing is playing in areas such as mid caps, which are set up to see some improvement in earnings growth, but don't require a very sharp improvement in the economic growth backdrop to work. So that's where we broaden out. We go as far as mid caps, but not as far as small caps.
All right, Hani, Redha, great to have you here. PineBridge Investments multi-asset portfolio manager. Thanks so much for joining us here to kick off the week.